Good day, fellow investors. Nick asked a great question because we discussed data, we discussed the risk and reward, but Nick wanted to know what's my feeling, and I said, I know you also want to know that, so better make a video to really discuss what's my feeling about the market. Not that much data, just what do I feel about that data. And also, Greg asks, Sven, what do you feel? Where will the bottom come? Will the market melt up, go down? So let's go into my opinion about the market because there's something very interesting about it. And Submatter here says, it feels very interesting, but nobody is talking about the debt cycle. So that's my biggest worry that I also want to share with you, because just below Submatter's comment, there was Zeno asking, Sven, what do you think about luxury stocks? This and that. And what's really remarkable is that nobody is talking about the big debt cycle. Everyone is talking about luxury, about the potential it has there, about the more money printing. And that's why you need to buy such stocks like this ugly bag. I don't know, as a value investor, it goes beyond my mind. What do people see in this? But that's why we are different, and that's why we make long-term money, hopefully. Now let's start with where will this market go and what is my feeling about it. If we look at the long-term trend, we really have been in a 40-year bull market. The market is up 40-50 times with dividends, even more. So we have had this very positive times, a little bear market here, a bear market there, and then since 2009 really a boom that stopped with the recent bear market in 2021, now down 15, not even 20% anymore, but still, this was really remarkable. This is a pure financially engineered market, as interest rates were kept at zero and central banks were just printing money to help us from this crazy crisis when the market was at 1,500 points, then it went down. Now to help us, to save us from the crisis, let's financially engineer a market even higher and everybody happy. Now, my feeling is that from here onward, with the price earnings ratio of 25 with the cape around 30, my feeling is that real returns will likely be close to zero. And I would not be surprised if this is what expects us over the next 15 years. Now, these are zero returns, zero nominal returns, really bad real returns. The market was down 75%, but I would not be surprised if we see these ups and downs. Keep in mind, this is zero, but there were constant crazy crashes and ups and downs and ups and downs as the markets needed to accept the new situation. So I think that given what's going on, we will have a lot of these swings, ups and down, up and down, up and down, that then might lead to stabilization in the long term, but the fundamentals don't look that good. So the Fed will try to react when things go bad, when economies go down, etc. So that is something that I am expecting ahead. Of course, when it comes to investing, I want to invest in a way that no matter what happens, I am okay. That's the core of value investing. So I'm looking at whatever happens, I want to invest okay. And if you enjoy this mentality that we can't predict the future, but we can be ready for everything, please smash that like button and consider subscribing to the channel. Also hit that notification bell, because I do a lot of videos from macro, from stock analysis, from educational videos. So also there is our YouTube portfolio that we just launched. I'll always keep the thumb with the number here and me like this, so you can then check your notification bell and see, okay, Sven, YouTube video portfolio, that's interested, I prefer macro, I prefer this. So really do that, because I think then you get the best value out of the channel. And if governments and central banks go deal with the debt cycle, with everything, we might even have an inflationary crash. So stocks might go up, but nobody could be happy about it because the real returns would be down. That's also something that I think can happen. I feel it will happen. It won't be tomorrow. It won't be linear. It can happen tomorrow. It might happen in 2037. So I know that there are very interesting times ahead of us, and the best way to protect ourselves is to own value, margin of safety, low risk, and then let the reward happen no matter what happens in the macro environment. Also, I agree with Submatter. I think that my biggest fear is the long-term debt cycle reverting, especially as the world isn't aware of it. The world enjoyed the last 40 years of lower and lower interest rates, and let's go on buy luxury brands, wearings, yachts, cars, whatever. There is plenty of money, and the problem is that we are in a clear debt cycle. So since the financial crisis, the debt, total bond market that was the issue in 2009 now doubled from, what is this, 2007 crisis, 70 trillion to now almost 140 trillion. From the financial debt crisis, now we have a double debt crisis, and now we are starting to see inflation. Now we are starting to see higher rates because this is a clear financial engineering bubble, an experiment, and this is the main worry. To protect myself from this, I need to own quality at a fair price so that no matter what the Fed does, because the Fed will react crazily, the Fed will do crazy things that will lead to busts and booms and busts and booms, and we see now the euro dollar getting destroyed. So that's something that's unpredictable. And also, when it comes to this debt cycle, who owns the debt? Pension funds. And if I look at euro area pension fund statistics, I see that 900 billion of that is in debt securities that are getting trashed with inflation, with the weaker euro. So people are losing 10, 20, 30% of their pension funds purchasing power, but nobody cares because it's not yet perceived. But if that reverts, and if people really start to losing purchasing power significantly, constantly, without the impact of the stimulus you got over the last 2 years, that's keeping you above water, then we might have real issues, real political issues, and then the experiments will continue to mount, and we'll have high, crazy volatility. And that's something we have to be ready for. So what did the central banks do at any issue hiccups? Just push more money into the system, 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 and now they will try to prevent it. But I know what's the next answer to the next gray or black swan: push more money into the system. So there is one certainty, that the currencies will get debased, devalued, and that's also my feeling, and I have to be ready for volatility and currency debasement. And now you'll ask, okay, if there is volatility, shouldn't we stay in cash? Yes, but if there is an inflationary crash, the cash gets burned. So you have to stay in value, not in cash. Long-term debt cycle also, if you increase interest rates, the value of homes, of financial assets, the purchasing power of that diminishes, which leads to negative impacts on the economy. Demographics aren't good. And that's something we have to think about, as the long-term debt cycle inevitably reverts at some point in time. Plus, if we look at home prices, those are now almost double than those were here in 2005, when it was already clear that the great financial crisis is ahead from a housing bubble perspective. Now we are double, and now everything looks good. Let's buy Louis Vuitton bags, tralali, tralala. So my feeling is it might go on for another 10 years, so I have to be ready for that, but it might also be that the party is over. So the key is to be ready for anything. And how to be ready for anything? Own value. Let me just show you also my positioning. So this is my lump sum portfolio that I started with 100,000 euros in 2019. Now we are at 200,008. So I did well over time. I have 20% in cash that I'm waiting for opportunities in special sectors that I like, and the rest is invested in one company that gains on volatility, dividend, another dividend payer, another that was very cheap, now it really is going higher, so oh well there. I try to detach myself from the market by focusing on value. So this is what I do, this is my feeling, and for now it's going well, and I really think that I own businesses that no matter what, 10 years down the road, these businesses will be really, really well. And then I also follow more 50 businesses on my research platform, and from there I want to source, because businesses go up and down. Sometimes this is unliked by the market but cheap, sometimes this. So there is the average, but around those averages there are exuberant and very pessimist businesses to buy. And I like to follow 50 from different sectors, and I always like those buys. I always find something interesting to add depending on the risk and reward. And that's how I go onward without having to think too much about what can happen. If I can invest so that no matter what I do well, that's the mindset I want to have. Impossible to predict. I gave you my feeling, but then again, my feeling is worthless. I want to invest so that even if I am wrong, I do good. And it's really about owning the business and not watching the market. And that's exactly why I just launched this YouTube portfolio. So on my research platform, I have 50 stocks that I cover and I'll put them into the portfolio. Here on YouTube, we'll do 30 to really cover 30 businesses, and we'll develop this portfolio over this year, hopefully, and see then how the business values are detached from the average market and how you can always find some value somewhere. So it will be a great educational voyage, so please subscribe for that. If you want to check what I do, check also my research platform, check the video that we made on the start of the portfolio. Subscribe for this investment attitude that I think will do good no matter what. Thanks, and I'll see you in the next video.